Well, the Federal Reserve wrapping up its September meeting moments ago and left key interest rates unchanged. Joining me now from Boston is John Canally, the Chief Economic Strategist at LPL Financial. So, John, the Fed saying in its statement that the case for a rate hike has strengthened. Now, that's similar to what Janet Yellen said in her Jackson Hole speech last month. But what do you make of the inaction here?
Well, it sounds like they just need a slightly little more evidence. You had three dissenters this time, which is relatively rare in this realm to have three dissenters. That kind of tells you there's a lot of discord within the FOMC. But I also think it tells you if we can get through the presidential election, if we can get through the next couple of months of economic data, and through the next couple of months without a big blow up in China or Brexit or some other kind of event, I think the Fed's on track to raise rates by 25 basis points in December.
Now, rate hike expectations were also scaled back for 2017 and the long run, future years. Now, the Fed has always stressed a slow and gradual path to normalization, but how should we interpret the downgrades in the longer term?
Well, the Fed's been kind of preparing markets for that. They've put out papers, and Fed Chair Yellen and Vice Chair Fisher have been out there talking about the lower path for potential GDP out there. I think the shift down in the dot plot for next year and for the long term reflect that. So next year it looks like they're now just expecting one or two rate hikes, as before it was three, and then in the long run they took it down from 3% to 2.875. So not too much of a move, but remember, 4 years ago in December of 2012. The Fed's forecast for the long-run Fed funds rate was 4.25. So now under 3, and that's come way down. Again, that just reflects lower growth, lower global growth, lower expectations, and just the ongoing slow recovery from the Great Recession.
All right, so maybe we shouldn't pay much attention to those longer-term forecasts. Let me ask you, though, what, in your view, might derail a December rate hike? Obviously, a lot could happen until then, including the wild card stemming from the election, right? I mean, a lot of people are saying if we do get a Trump win, perhaps the Fed delays its rate hike, just given the uncertainty around Trump's policies.
Yeah, I think it's very, there is a meeting in November. I think it's on November 2nd. It'd be very unlikely that the Fed would use that opportunity just a couple of days before the election. That does lead you to December. And between now and December, sure, I think the big event is that the presidential election. I think the markets would prefer that Mrs. Clinton win, only because she's less of a wild card, and Mr. Trump seems to be more of one. And I don't think the Fed would probably take that into account. But there are other things that could cause the Fed to not raise rates in December. If we get a really bad run of economic data here in the next couple of months, that could do it. I think if China decides in the next couple of months to rip the Band-Aid off on its bad debt problem and fix it, that would probably be too disruptive for the Fed to tighten into.
Right,
if Brexit for some reason gets launched now instead of next April, that could do it. So those kind of things. But I think the data is the key. If the data really start to come in weak, I think the Fed would take a pause, and then we'd be looking out into early 2017.
All right, just quickly, let me just ask you sort of what you're doing with your money now that we know that the Fed is sort of on pause, at least for the next few months.
We still think that you can get a modest gains here in the stock market. You're going to get more volatility. I think bonds are now beginning to come around to the realization that not just here in the U.S., but globally, the central banks have kind of done all they're going to do. That might help to push bond yields up a bit. So we still favor stocks over bonds. Not much of a gain in stocks over the rest of the year.
What about the banks?
Yeah, I think that would help, but also things like MLPs and even REITs. Even when the Fed hikes rates, if the real estate market's still going strong, REITs can still work too. Banks are something that people are taking a look at, but I think in general, I think what you're likely to see, at least between now and the election, is more volatility. Then as we get ahead of the Fed meeting in early December, you probably get some more.
All right, John Canally, the Chief Economic Strategist at LPL Financial in Boston. John, thank you.
Thank you.
All right, I'm Scott Gam, and you're watching The Street.